Chapter 4, Part 1, the multi-step and single-step income statement. Elements of the income statement. We have items shown pre-tax. First, we have revenues. These are inflows that increase assets and are part of the primary business, i.e., you wouldn't include interest income in this area. Expenses, assets consumed generating the revenue that is primary to the business. This also includes restructuring costs. That gives us operating income, and they also call that non-GAAP income because it doesn't include the next part, which is, and this a lot of times is when people have to report, this is all they talk about is the operating income, and they tend to exclude other, which includes gains or losses, which increase or decrease in net assets that are incidental to the business, unusual, infrequent gains or losses, shown as part of other, and these are all shown pre-tax. Now, items shown net of tax, discontinued operations. When the elimination of a component represents a strategic shift having a major effect on the company's operational, financial results. You should show any loss or profit or gains, losses from disposal of equipment separately. So you'd show loss from the operation and then second loss from, or loss or gain from selling off the assets. And then after you do that, you get net income, and then you also get a second part, which a lot of times is a second page, and it's called Other Comprehensive Income. These are items that bypass the income statement, including pension adjustments, unrealized gain or losses on investments, deferred gain or losses from derivatives, and foreign currency translation adjustments. These are always shown net of tax. So, multi-step income statement. Remember, you list expenses based on how closely they relate to the business, the generation of the core revenue of the business. Cost of goods sold first, then selling, administrative, and other expenses. This tells investors if you're making money in the business you're in, because they want to know if you're profitable. So remember, you only include things in revenue when you're doing multi-step and cost of goods sold if they're part of your primary business. If something is outside the scope of your primary business, it is in other. Because again, it's important, you need to know how a company is generating the money. So now what we're going to do is we're going to do a multi-step income statement. Now, using this partial adjusted trial balance. Now, if you look this over, you will see that this has all different kinds of elements of what could be on the income statement. We have interest revenue, some unrealized gain, gain on assets of discontinued operations. We've got some sales returns. We've got restructuring costs, and we've got foreign currency adjustments, just some of the things. So I've tried to cover a lot of unique items on this so we get a understanding of what an income statement, how it can look. All right, so first what we want to do, now this is what I do. I'm showing you how I work a problem. What I would do if I were preparing an income statement is I would print out the adjusted trial balance, because that's the only one we can use to do the income statement on. And then what I would do is I would know that on that adjusted trial balance, I have to use everything. I have to check it off to make sure I use it, because otherwise I'm not going to get the right answer at the end. So if I'm going to determine gross profit, what I need first is the sales. I need sales returns and allowances, and I also need cost of goods sold, which remember, that's an expense. Now what we can do is we're going to do sales minus returns and allowances, and now we have net sales, and that's how we're going to show it the rest of the time. And that's how they usually show it to you in financial statements. They show you net sales. Returns and allowances have already been subtracted out. Then we're going to subtract our cost of goods sold, and that's going to give us gross profit. Now we're going to determine operating income. So we're going to identify all the elements that are subtracted from gross profit to get operating income. So it would be our selling expenses, our administrative expenses, and our restructuring costs. So we're now going to take net sales, gave us gross minus cost of goods sold, gave us gross profit. Then we're going to subtract our other operating expenses, and now we have income from operations. This number tells you if a company is making money in their primary business, and all items above this total are shown pre-tax. This is also again known as non-GAAP earnings. A lot of companies like to focus on this and ignore the next section, which is other. Now we're going to determine other income, expense, and net income from continuing operations. So that now would include our interest revenue, our loss on sale of investments, our interest expense. And that would be it. Now remember, unrealized gain is going to be part of other comprehensive income, so it's not included. All right, so now we're going to prepare that section of the income statement. So we're going to, again, we have gross profit. We're going to subtract. Make sure you subtract. Don't add. Sometimes people do that and they say, oh, there's something wrong. Yeah, you got to subtract your expenses. That's going to give us income from operations. Now we're going to go to other, and now we're going to take that out. And now we're going to have income from continuing operations pre-tax. So remember, everything above this number is pre-tax. Anything shown after this number is always shown net of tax. Now we're going to take out our taxes, and now we have net income from continuing operations. And this is net income if there are no other taxable types of tax transactions, or if there isn't a discontinued operation, or there's no other comprehensive income. But of course, in our case, there is. Now, what follows? Items that may appear net of tax following net income from continuing operations would be discontinued operations, and then 2, 3, and 4 would be part of other comprehensive income. That would be net income attributed to a non-controlling interest. You learn about that in advanced accounting. Plus or minus foreign currency adjustments and any other comprehensive income item. But those are all shown net of tax. So now let's go back to our adjusted trial balance to see what we have to add. All right, we've checked all these back, but lo and behold, we do have a discontinued operation. So we have a gain from sale and we have a loss. So now we're going to put that on the financial statements. We go here, we're going to show discontinued operations, loss on discontinued operations. And then we're going to add in the tax benefit, and we're going to add in the gain. And less tax on that gain, and now what we're going to get is 504, which we're going to add back in as to get net income. Now we're going to go back to our trial balance, because now we're going to look to see, do we have anything for other comprehensive income? We do. We have some unrealized gain, and we have a negative foreign currency adjustment. So we have to account for this one, and we have to account for this one. So what we're going to do is we're going to show it unrealized gain, investment, net of tax, foreign currency adjustment, net of tax. We're going to add back in 48,000. And just so you know, it would be 320 times 60%, that's what gave you the 192. That would be what it would be, less tax. And the loss of 240 times 60% would give you then only 144. Now, earnings per share. You do not use any of the comprehensive income items. So here's how you would do it. You would do earnings per share of $32.91. That would have been our net income, continuing operations. And then to come up with your common stock outstanding, you would have taken 1,000,000 plus 400,000 divided by 2, because you only have the stock for half a year. That would give you 1,200. So earnings per share on continuing operations would be 274. Then you would separately calculate discontinued operations. That would give you 42 cents. So your total earnings per share on net income is $3.16. Remember, other comprehensive income is never included. Now let's take a look at this whole thing, and what would it look like if it was single step? Okay, you'd still have your net sales. You'd include your interest revenue, would give you total revenue. Then you would subtract out all of your expenses that are part of operations, and then following that, it's all the same. Now, one last page I want to cover is accounting changes. We have really 3 things that can happen. You can either have a change in accounting principle, a change in estimate, or a change in reporting entity, or a correction of an error. If it is a change in accounting principle or a reporting entity, it's always retroactive. If it is an estimate, it's only treated current year and forward. If it's correction of error, it depends. If it's discovered in the same year, it's just a reversing entry and fix the error. If it's from prior years, you do not show it on the income statement. Instead, you treat it as an adjustment to beginning retained earnings. And that concludes this presentation.